Welcome to Poor Millionaires. Today's guest is fireman turned venture capitalist Cody Shirk. Despite being a self-declared American patriot, Cody is setting his investment sights overseas in hunt of better value opportunities. Is the era of US exceptionalism over? Poor Millionaires is the show for people with investable wealth of $1 to $20 million. We strive to educate, connect, and inspire, to give you the tools you need to thrive and secure lasting prosperity for yourself and for your family. PoorMillionaires.com. Invest with ambition. This podcast is for educational purposes only. The information does not constitute financial advice or recommendation and should not be considered as such. Value investments and any income derived from them can fall as well as rise, and you may not get back the original amount you invested. We're really lucky to have Cody on the show because his story is nothing short of inspirational. Cody, you're quite difficult to pin down in terms of your CV, and for our American listeners, that means resume, right? So give our audience a quick overview of your background and your journey as a poor millionaire, because you didn't exactly take the sort of conventional route to invest in, did you?
I definitely didn't take the conventional route, and maybe in hindsight it may seem cool and glorious, but I can tell you, going through it, it felt it felt miserable and scary, and no light at the end of the tunnel. But I'm here now, so I'll briefly go over my my history of how I got to where I'm at now. I grew up very, let's say, like middle lower class. I grew up in the United States, in a first world country, so I'm not going to complain about my ability to be fed, but I definitely was not at the top echelon at all. My father was a firefighter in California, and that's how I grew up. That's all I knew. Blue collar worker, paycheck to paycheck, and just consume not only information, but your friends, everything around you, just of what you're given, meaning you don't really have a vision outside of what you can be or how you can grow. So I was a water polo player through high school and actually got a scholarship to play water polo at university in the United States. And honestly, that's probably the only reason I went to university. After that, I became a firefighter myself. Did well there for about almost 10 years in the Los Angeles area.
And was that always kind of like a childhood sort of dream of yours to become a fireman?
I mean, yes and no. Yes, just because that's all I knew, but no, because I think I'm just a curious person by nature, and I was always looking at other things. So when I was a firefighter in LA, I was investing on the side, and what I would do, the schedule was very interesting. I won't tell the exact schedule because it's very complicated, but basically I would work 10 days a month and then I have 20 days off. But what I would end up actually doing is you could sign up for overtime, like an unlimited amount of overtime. So I'd work my ass off for days on end, and then I'd have like 4, 5, 6 days off, and I'd book a flight somewhere around the world. Like I'd just go somewhere. And me having this view of like just total blinders on, just having no idea how the world worked or how financial markets worked, I thought, I can't make it in the US because it's too competitive in the US, it's too expensive. So I need to go other places to go where I could be a big fish in a small pond. And that led me all throughout Latin America, Asia, Europe, everywhere, looking for deals. I put air quotes on deals because I'll tell you, they weren't deals, but I got involved in all these different like private equity deals and real estate stuff.
The art of the deal, eh?
Yeah, exactly. The art of the failed deal, more like that. So I did that for a while. I overall was successful, but got my MBA in hard knocks, which is just getting my teeth kicked in by doing stupid deals, getting my money stolen, being robbed, like literally and figuratively. And anyways, eventually was able to leave the fire department and started my own investment firm where we've done investment deals around the world. And today, I'm fast forwarding today, I'll wrap the story up. I'm married, I have 3 kids. I'm living in the United States now. I'm a total patriot of the US, and I'll be happy to dive into why I'm such a patriot of the United States. And that's me doing deals in mainland China, Australia, all throughout Latin America, Europe, Africa. I have done it all, and I can say I'm a very proud patriot of the United States, despite all of its flaws. So I have 3 kids, married. I live in Florida, and I manage my own money and some other people's money as well. And that's where I'm at now. So let's dive in wherever you want.
So Do you think that kind of like having an unconventional route into investing is an advantage as an investor? Does it give you kind of like a different perspective? Because a lot of poor millionaires can probably relate to sort of feeling like an outsider when it comes to investing because they don't necessarily come from kind of like an investment background professionally. So what do you think about that? Is it an advantage?
If you had asked me 10 years ago, I would have said no, absolutely not. But of course, now I would say absolutely yes. And I think the easiest way to answer or explain what you're asking is, I now have friends who were, went to private high school and then, went to an Ivy League school in the United States. They went to Harvard or Yale or whatever. And they were basically part of this family or cult, this pedigree of you would just go on this path where you're pretty much guaranteed to make money, but you're also like exposed to a worldview that's completely different than anybody else. The flaw with that is that on one hand you can make a lot of money, but on the other hand you're very just completely ignorant to a lot of things going on in the world. The opposite is true for people that were or are in my position, which is growing up in a very like lower middle class household, not understanding investing, not even understanding money, not even understanding budgeting. The
Yeah.
path to learn that is very painful, but once you learn it, it's much more firsthand, and it's also much more it's much more real world. Because if you're growing up wealthy and you don't really understand what it takes to get to a certain level, you can operate at a certain level, but there's some steps you miss in there. And I find that a lot of my friends who went that path are now at a stage in their life where they maybe missed out on a lot of life lessons in their life.
And nobody teaches this stuff in schools, do they? I
Of
mean, it's
course,
kind of like fundamental to living, understanding money, understanding how to budget and to run your finances, but it just gets completely ignored in schools.
isn't it ironic that the things that we learn in school are the things that we use least in life, and the things that we use most in life are the things we don't learn in school?
Yeah.
Budgeting, finance, but even like simple things like cooking or like how to do some like simple auto repairs or stuff like that. It's super ironic. So yeah, going back to answer your question though, yeah, I obviously am biased, but I think having this path of coming from a very low knowledge of financial markets, investing, and taking control of your destiny is much more satisfying, I would say, for me to get to this point now, knowing what I've been through. But I think for someone who's looking and saying, like, how the hell do I get there? How do I do this? Or like, how do I get to that next level? The answer is you just do it. You just start going for it. And the reality is you don't need to go to Ivy League school. You don't need to start with $1 million. You don't need to have a family lineage that's going to ensure that you succeed. What you need is just an internet connection and start watching YouTube videos, listening to podcasts, and go take some risks. That's like what it is. Go out into the world, take some risks, shake some hands, knock on some doors, skin your knees, and get involved in things so you can learn. Obviously, make that list low on make the risk low on how much money you're risking, but take some risks on what you are personally doing with your time and what you're exposing yourself to. And I would say the one thing that I'm most proud of for myself is doing that, just taking risks, going out into the world, exposing myself to people and ideas and places that I never would have encountered if I had stayed in my bubble. And that has just opened my eyes to a whole different way of viewing how I can grow as a person.
Yeah, it's interesting. I think a lot of people get hung up on the theory and kind of, they constantly umming and ahhing over different options in terms of investments and things. But it's an important thing to actually just go out there and get started, isn't it, in some form or another?
For
Um,
sure.
so it's often joked about in Europe and the UK that very few Americans own a passport. And I guess it kind of makes sense because America's this sort of really diverse country, geographically and otherwise. But in a similar vein, I think it's fair to say very few Americans invest outside their home country as well. And that's not necessarily been a bad thing recently, obviously, with the outperformance of the US market. But you're an advocate of international diversification, aren't you? Given the recent sell-off in the US, is it finally time for US investors to pivot to international markets such as Europe and, dare I say, the UK?
The answer to your last part of the question, yes, absolutely. But let me touch on what you first said, which is this assumption that most Americans don't have a passport or don't travel outside their border. I mean, we could look at statistics, but just broadly speaking, I think that's less true today than it was even 10, 20, 30 years ago. And I would say that's mostly because of costs. And what I mean by that is, the US is a pretty big place. And to go outside of the US, other than Canada or Mexico, it's very expensive to go. I mean, you're flying across the Atlantic, or the Pacific. So just as someone in Europe and Asia, it's expensive to come to the US. The same is true the other way around. So for the normal US person, why would you spend, I'm talking 20, 30 years ago, why would you spend all this money and time to go somewhere when you can probably get something close staying domestically? Now, of course, I skipped over a lot of why you would do that. Of course, it's cool to see other cultures and be enriched and have experiences and all that. But I think now that travel, I'm saying generally worldwide, it's much cheaper. Airfare is proportionally cheaper now than it was decades ago to travel. I think the U.S. population is much more adventurous and willing to go outside their borders. Also, just with the proliferation of the internet, information, et cetera. So I think that's less true. But the U.S., everyone sees the news about the U.S. There's shootings, there's corruption. You've got the presidential crisis of every 4 years. And just like outsiders look at that information of the U.S. looks at similar information to outsiders, meaning we're watching chaos out in other parts of the world too. Everyone's being served up different propaganda.
The UK is not exactly covering itself in glory lately.
Yeah, but that's been true for centuries for all countries, which is, certain regimes or certain governments want to have a certain narrative about what they're doing, but also about what others are doing. And it depends what information source you're getting. But now that we have platforms like this, we're talking on a podcast or, X or the internet, whatever, there's more transparency. So I think there's ability for Americans specifically to have a little bit more understanding of what's going on around the world. And to get to the last part of your question, which is the idea of investing outside of the U.S. and borders, two things have happened. One, everything I just said, which is just this understanding of the world more and having more transparent information. But the second thing is just access to markets. I mean, it's been very difficult for a U.S. investor, say 20 years ago, to go invest in the stock market in Thailand or Indonesia or even Hong Kong. It was difficult because you had to go set up brokerage accounts and get, Mother, may I do this, and sign documents. Now you just, get on a brokerage account, get on Robinhood or whatever, and there's all kinds of listed stocks and investment opportunities around the world. So there's a much broader opportunity for U.S. investors. And specifically right now, we're talking middle of 2025. We've all seen the charts of the equities ratio to commodities, or the U.S. stock market valuation compared to emerging markets. We've all seen these charts, and they're at the most polar opposites we've ever seen, perhaps even financial history, probably over the past century, which is essentially U.S. tech and U.S. super valued companies are trading at valuations that are mind-blowing. I know Palantir today is a PE over 600. Can Palantir justify that? Like, maybe if they turn into $100 trillion company in the next couple of years, like, come on, that's not going to happen. But my point with what I'm saying is that if U.S. investors or investors around the world look at this narrative of saying, okay, valuations are super high, we're at record high valuations. I'm not talking about the numerical price of stocks or the indices. I'm talking about the valuations. The valuations in the U.S. are right about at the historical high. And how much more growth can we have? I'm sure we'll have more growth, but not at the valuations we're currently having. So the opportunities that present themselves around the world, but especially I would say in like second tier markets, I'm not accusing UK of being second tier, but as far as the size, maybe second tier, meaning the actual size of the economy, it's super attractive. So in countries like Poland or Germany or Hungary or Italy, or basically all of Europe on a valuation metric is multiples lower than the U.S. So just if you were looking at value of investing, I think Europe looks very interesting. And then if you expand to Latin America, Asia, and some of these other like third and fourth tier markets, I'm talking in size of the market themselves, we're dirt cheap valuations. So that was a very long answer to say, yes, there's absolutely big opportunities, and investors should be rotating right now out of these super high valued equities in the U.S. into other more cheaply valued opportunities.
Yeah, I guess it's important to kind of separate, economic growth from stock market performance as well, because you can have kind of like a strong economic performance, but not a great stock market performance, and vice versa. Obviously, in Germany recently, we've seen the German DAX do really well, but the economy is just flatlining. So I just wonder kind of What markets in Europe right now are kind of particularly attractive? And is Europe kind of the obvious home for US capital, given that the cultural similarities and the legal system and all that kind of thing?
So just to address the first part of your question, which is the stock markets may be performing or losing correlation with the performance of an actual country. I actually think that will increase for all countries going forward, and it actually already has pretty much happened in the U.S. for the past couple of decades, and it's just because of the internet and domiciled companies. Let's say a company's domiciled in Germany, they could be doing business around the world. So the performance of the local German economy doesn't necessarily predicate how that company is going to perform, and I think that will continue on more and more as the world continues to digitize itself, and we have companies working internationally, and we also have financial markets that are much more broadly based, especially with the introduction of crypto. What was the second part of your question? I got sidetracked to that. Sorry,
Is
I wanted to
Europe
address that.
the obvious place for Americans to kind of diversify into?
I think as a European, you would want an American to say yes, of course. I'm not going to take that bait, though. I would say it's interesting. I'll take that back. I think a year ago, yes. I think a little bit of that momentum, or let's say the trough of the valuation and performance has been gobbled up in the past 12 months. I mean, I'll use an example. Poland is the number one performing market in the world for 2025. I'm not talking about the economy. The market is. They're up like 40% or something like that. So could they go again another 40%? Could they continue to go up? Absolutely. There's absolute possibility, but I think a lot of those early gains have already been exposed. And the reason why is because everybody was so bearish on Europe last year. Everyone remembers this. It's like, oh, Russia's going to roll over Ukraine, go into Europe, and Europe's backwards because there's so much bureaucracy and taxes, and they don't have defense, and everybody's squabbling with each other. But that would have been the time to invest, right? That's like being a contrarian or investing in the low. So I think Europe's still interesting because relative to other markets, it's developed in the sense that there is somewhat rule of law and there are financial markets that work in Europe. But if I was to compare it to other markets, say like Brazil right now, or like the Philippines or Indonesia, I think there's an argument that there's some other places that are even more interesting from a valuation and opportunity to have huge gains in the coming years.
So let's talk about emerging markets then, because you mentioned Brazil. Are there any other markets that are catching your eye right now? And are they kind of like a good place to look at? Because obviously with the dollar looking to kind of weaken, it's obviously going to be good for those countries.
Absolutely. I think broadly speaking, everyone would agree that we're generally headed in a direction with more technology and more digitization. And the first wave of this has been shown in the insane valuations of tech. But to support all this tech, you need infrastructure, right? You need power. You need like literally cords. You need power lines. You need fuel. You need minerals. You need metals. You need all of these things to actually support the hardware. Yeah, exactly. You need the things to support the hardware that's going to build out a lot of this digital world. And the things that stand out, or the places that stand out, are Australia, Indonesia, all of Africa, and all of South America, in terms of actually having rich resources that first world countries and major world powers want to exploit. So I think the emerging markets that look very interesting, that are very inexpensive right now, are many of those countries that have lots of those resources that are going to be exploited and currently are. Like I said, Brazil is one of them. We have Chile, Peru, Colombia to a lesser extent, and Latin America, Ecuador a little bit, and Argentina, obviously. But Argentina has been a pretty big success story from their capital markets perspective because of Malay.
Yeah.
Africa is very interesting, although I know I've invested in Africa many times, but I'm hands off on Africa right now. I'm very bearish on Africa, and that's just because I think the continent's going to spiral out of control because of more and more conflict, and we can dive into that later. And then Indonesia and I guess just like the whole Southeast Asia area, very resource rich again. And depending on how much China is going to consume in the coming years, they could have some really interesting opportunities there. But all those countries I just listed also have interesting demographic profiles compared to, say, the US or Europe. So you You could look at all those emerging markets from their ability to export minerals, but you also want to look at those markets domestically because they have a much younger population compared to lots of Western nations. And that, like, India is a good example too. You have this population that's younger, and it's going to about the demographic. If you look at the demographic charts, about to shift into this area of consumption, which is, buying diapers and driving the car around and buying household products. And regardless of what happens to the leadership in a country, generally speaking, a demographic that's consuming things will fuel the success of a country if that age demographic is right. The inverse is true as well for places like Japan that's had stagnation, and China. Everyone's afraid of China having a crisis from the one-child policy. So, yeah, that was a long answer again to your question.
Let's pick up on Africa then, because that's an interesting one. So the demographics in Africa are pretty good, right?
Fantastic.
But you mentioned it's a no-go area for you. So
Yeah,
they've also got a lot of natural resources. So what's so bad about Africa?
So if you look at demographics, it's kind of like the Three Little Bears situation. It's like, you don't want your soup too hot, you don't want your soup too cold, you want it just in the middle, right? Yes. So if you look at demographics as this Three Little Bears situation, you don't want your population too old, because if that happens, not only do you have not enough people having babies, but you have an older population that needs to be taken care of. And this burden gets put on this younger population to not only have more babies, but to make more money and produce more things. And that's exactly what's happening in Japan, South Korea, most of Europe, Italy, Spain. There's just not enough younger people to support this older population. So that's like on one end of the spectrum. The other end of the spectrum is having too many babies. So you have the whole Sahel region of Africa, which is, Chad, Niger, Burkina Faso, and then to a lesser extent Nigeria. Their average birth rate right now per woman is like almost 8 babies per woman. And when you have too many kids, when you have too much youth, and there's not enough infrastructure to put these people to work, to put them into a system that actually produces things, you have chaos. You have terrorism breaking out. You have these break-off military groups that are going to pillage their neighboring country to steal resources. And, without going into too much depth, you can understand why that happens. Because imagine you're in a country and there's a bunch of young people and there's not enough food, there's not enough jobs, there's not enough anything. What are you going to do? You're going to try and survive, right? And that's more or less been the story of Africa, unfortunately, for the past couple of centuries. There hasn't been enough infrastructure and structure for a society to bloom. There are some success stories. We can look at Nairobi and Kenya and some other select cities, but I think in those regions that are having a ton of kids right now, it happens to be in a lot of the resource-rich areas, there's going to be a lot of chaos. And just to put a bow on what this all means, at the same time all that's happening, you have Russia, China, the US, lots of European nations sending in their military or their paramilitary groups like the Wagner Group to take over resource extraction zones. Like Mali is a perfect example. The Wagner Group has seized a lot of gold mines there, and they're extracting gold to not only fund the Russian economy, but also to get minerals that they need for whatever they're building. So as an investor, you got to look at risk. Yes, there's a lot of money to be made in Africa, but there's so much risk there. And one thing I've learned over the 2 decades of me investing internationally, and like in the beginning of investing internationally, like, oh, this is awesome, make a ton of money, and this is risky, but I'm going to weasel my way out of this and pull out a win. Like, good luck. The number one rule of investing, as Warren Buffett says, is don't lose money. So if you don't want to lose money, don't invest in Africa right now.
So talking about risk, what, based on your experiences and interactions with fellow poor millionaire investors, what are the common pitfalls for this group of people when it comes to stewarding and looking after their wealth? What prevents them from making it to kind of like the next tier on the wealth pyramid, so to speak?
Well, I think there's like 2 things that stick out immediately. The one that I just said, which is taking risk or taking big swings. In the U.S. we play baseball, and it's called like just taking a big swing with your bat. I don't know if it's like a cricket, or some sort of like
knocking one for 6.
Yeah. Don't try and knock one for 6. Just knock one for 1 or whatever the saying is. Just like we call it going for base hits. Just get on base. You don't want a home run. You just want to get on base. And I think there's a temptation, especially when you're younger, or if you feel like you have to take this quantum leap to a next step to get wealthy, there's this feeling like there's a visceral feeling like you need to take huge risk, right? And I
Yeah.
think that's probably common throughout human history, is people doing that because they assume that they have to take a huge risk to get that to that next step. You do have to take a huge risk, but that risk should not be with your capital. That risk should be with your time and energy. So I think the number one mistake people make is just continually taking these big swings or these big bets and failing and thinking, oh, the next one will work, the next one will work. But what you're really doing is you're just losing money every time, as opposed to if you took these little small bets that are with much less risk, getting on base and slowly building it, then you can take those risks when you get bigger. The second big risk that I see investors making is not having enough liquidity. So in addition to taking these big swings or these big bets, sometimes investors will put a lot of their capital into an investment that may have huge payoff, but their capital gets tied up for, say, 5-10 years. And this is exactly what's happening in the United States right now with the private equity market and real estate, which is people are, we call it in Silicon Valley, people call it, oh, I'm pre-rich or I'm paper rich. And like, well, what does that mean? Like, so you're rich because you can show me this document that has a bunch of zeros on it? Well, how, like, let's go out to dinner. Can you afford whatever amount of money every night? And, oh, no, I can't because all my money's tied up. So are you really rich? And it sounds like a little bit of a superficial thing, but it actually is a real problem, which is you invest in these things that show that you have a certain amount of wealth. But if you try and get that wealth out of it, you can't. So what does that like really mean? And I think that problem, especially in the US right now, is going to come back to bite a lot of people in the ass, especially as certain real estate assets and private equity assets get written down. There's going to be an evaporation of wealth that the people never really had. Maybe it's set it on paper, but they never really had it in their hands. So for somebody who's trying to build their wealth, avoid taking those big hits, and any hits you do take, make sure they're smaller, less risky, and that you do have liquidity. You are able to take your capital out and reinvest it, recycle it into the next opportunity, because there's huge opportunity cost that you're risking by putting capital into something you can't get out of. So those are the two things that really stick out.
So you mentioned real estate and private equity, and obviously you've got a lot of experience in venture capital, private equity. But private markets, it seems to me, lately are one of the things that look like they might be a little bit overheated, at least in some areas. And in your experience, I mean, investors seem to be really drawn to private equity as almost like something shiny. They can't resist it. And I guess same with real estate, because it gives them bragging rights and that kind of thing. But are investors, poor millionaires in particular, too fixated on these asset classes?
Absolutely, 100%. I think in the US, the narrative for the past decade has been, if you're younger or even if you're older, you look at these guys and gals, specifically in New York, Silicon Valley, Austin, Miami, Chicago, Seattle, investing in early stage tech companies. And this idea that you can be a venture capitalist and you're going to have a huge exit, you're going to put in $1,000 and it's going to be worth $1 million a couple years later. That was actually happening. That was a real story, but that was happening in the early teens, the 2013, 14s. It's weird to say teens now. That's like, feel like I'm like in the early 1900s, but that was happening.
I'm getting old.
Yeah, exactly. Yeah, I'm like losing my hair and everything. That was a story that was unfolding 10 years ago. But most retail investors catch on to trends like too late, right? We were talking about Europe. It's like usually the thing to invest in seems terrifying at the time. And when you finally get comfortable to jump into an opportunity, it's typically too late. That's why a lot of people get caught in these situations where they're never really making money. So specifically to what you're saying, the private equity, I think there's a lot of investors who invested in later stage private deals that have not gone public or have not had a liquidity event. So this is people who invested just prior to the pandemic era. And the reason why the pandemic era is important is because rates were going down all the way until the pandemic, right? I'm talking about interest rates globally. We haven't had negative rates, right? A lot throughout Europe, negative interest rates. And this was through the pandemic as well. So people are taking big risks. And when you take big risks on opportunities that are illiquid, the worst thing that could happen is if rates start going back up. And that's exactly what's happening right now. So as we have an interest rate environment that's going to be increasing, and I wish I could show a chart right now, but the interest rate trend from the early late 1970s, early 1980s in the United States is going down.
Yeah.
And then when it hits right around 2022-ish, we're going back up. And when you're in it, we're in our lifetime like this. I was born in the mid 80s. It's hard to see. I can't put that into context. I didn't even know about money until I was like, whatever, out of college. Like I was dumb then. Kids don't know shit about money until you're a little bit older. But when you're like this, it's very hard to see that trend in interest rates. But if you look at a chart, anybody can pull a chart up of historical interest rates. It's very cyclical. It's up and down, just like the waves in an ocean.
Yeah.
So we are in an increasing interest rate environment. And when that happens, risk assets like private equity, like venture capital, are going to perform very badly. So these people that did deploy capital are right in the trough of this interest rate trough. Bad timing. And to be honest, like I did some of that too. So I'm not going to like pretend to be a genius here. I have some deals that are locked up and it's very frustrating. So going forward right now, just be very careful putting your money in any deals that are going to play inversely to the previous interest rate cycle, because the reality is interest rates are going up. It's going to cost more money to borrow money, and any venture or company or anything that requires cheap capital is going to have a very tough time going forward.
I guess there's a lot to be said for public markets, isn't there? Because you talk about liquidity and having access to your capital, but public markets seem to have gotten a bit of a bad rep recently, and we hear about the amount of public companies decreasing over the past couple of decades, and all the big profits being in private equity, especially for these big tech companies. So how do we kind of get poor millionaires excited about public markets again?
So just to address what you're saying specifically, for the past decade, most stock investors who have performed very well have just been in indexes or ETFs. I think everybody knows about this. Like it's very hard to beat the market and compared to just putting your money in SPY or VOO. These are US based ETFs. I'm sure there's lots throughout London and throughout Europe. You just put your money in an index, which tracks the general performance of the market, and you'll do well. At the same time, hedge fund managers have been performing not very well. For example, Ray Dalio, Bridgewater Associates, everyone knows Ray Dalio. I'm not picking on Ray, but Bridgewater has underperformed the market for multiple years. And one problem is he has so much money to manage, but another problem is it's very hard to be a stock picker when the entire market's going up, right? You're like trying to outperform a market that's already outperforming. So it's like very difficult. And so that, going back to what we talked about previously, that's why a lot of people went to venture capital, because venture capital was actually performing better than public markets in select deals. We're in the opposite scenario now, which is stock picking for the foreseeable future is going to, in my opinion, outperform indexes and ETFs because generally speaking, we have a rising interest rate environment in addition to more geopolitical conflict. As we're talking right now, there's something unfolding in the Middle East, and we all know about Ukraine. For the past century, we've been in a time period where the world's been very peaceful. It's highly likely we're going to have more conflict going forward. And all those combined together point to and with markets at record high valuations, as I said in the beginning of this podcast, all of those things combined together probably suggests that indices and broadly based ETFs are going to underperform. And what is going to perform is picking stocks, picking undervalued countries and companies and opportunities that will likely perform into the future. And another thing to note, a lot of those undervalued countries and companies and all those things, they actually are not in the ETFs because they have performed so horribly for the past decade. The ETFs don't select those companies. So that the actual opportunity is to go after the things that have underperformed and are not included in these indices because you would not normally get exposure to them. So I actually think hedge fund managers are going to do really well for the next 10 years. I think individual retail investors who take control of their finances and are very disciplined and go after deep value opportunities is going to do very well. And of course, private equity and the industries that thrive on cheap capital are going to really struggle unless they have some crazy, magic box, some AI this or that, or they're catching a tailwind of, or they have a tailwind of, like, say, in the defense industry. A lot of those startups are doing very well right now.
Yeah, I think that'll be music to the ears of those long-suffering active managers out there.
Yeah, I feel bad for any hedge fund managers who, especially launched a fund, say 5, 6, 7 years ago. It's been a tough, like, how do you beat a market that's going up, you know, 15, 20% a year? And that's what was going on in the NASDAQ. If you just put your money in a QQQ, which was the, the NASDAQ ETF, like how are you going to beat that as a hedge fund trader? You're not. I mean, some guys did, but the average hedge fund trader, it's impossible to.
So we talked about diversification in terms of asset classes and different markets, but another aspect of diversification is your citizenship and residency. And you've actually helped people get second passports and residencies.
No, I haven't really gotten involved in it. I've done trips to other parts
You've
of the
dabbled
world.
in it.
Yeah, and I've said, like, here's this or that. I haven't done it myself. Actually, I did do. I went through the whole process in one country, but I don't want to. Before we go too far down that road, I don't want to get into like I was some passport dealer or anything like that. I was not at all.
Right.
I've done investing trips to other countries, and people have said, "Oh, this is an interesting country, and you can make an investment to get some citizenship." But I haven't actually like been involved in that whole route. So
but you would actually say that it's a good idea, though.
I think I've gone full circle on this, and I think as an investor, one of the toughest things to do is change your mind. And one of the beauties of I guess of getting older is you're not afraid to look dumb. And I feel pretty dumb saying this right now, but I feel like I've gone full circle on it. And I'll tell you a story real quickly to tell you what I mean. I when I was a firefighter, I was involved in let's just say some government stuff where I got exposed to a lot of things that I didn't know existed. I became let's say a bomb tech. I became a hazard materials specialist. I became let's just say exposed to a lot of stuff that's going on in the underworld, and it made me scared. It was like, oh my gosh, the world's going to come to an end. And what we're watching, what's happening in the Middle East. I'm seeing what's happening in the news, and I also know what's actually possible, and it's actually much more terrifying than the average person would think. And I'm not trying to scare people. I'm just saying that was my mindset 10, 15 years ago. So the idea of having a second passport was very obvious to me. It was, hey, let's have this diversification plan, bug out plan. Let's have, gold, the whole story. As I got older and kind of understand how the world works better and realized, not everything is doom and gloom. I started to come around, but the thing that really changed my mind was during the pandemic. I live in Florida now. I'm originally from California, and during the pandemic, the number one most free place in the world was probably where I lived in Florida.
Yeah,
we could do anything. Restaurants were open. The economy was thriving. Nobody was sick. Everyone was outside, and I'm sure there's all this, this COVID that, and there's all kinds of conspiracies. But what I'm saying is, the freest place I could have been in the entire world was not the place that other people got second passports. And in fact, the places that offered that, like New Zealand and Panama and all these countries that you thought were like these, I'm going to live in the jungle or live in this remote area, they're the countries that locked down the most and became the most like crazy Orwellian 1984. We're going to control your life. We're going to lock you in your house. And if you come out, we're going to put you in a jail cell. That did not happen at all where I was living in Florida and most of the US. There was definitely some states that went a little crazy. So I had this epiphany of, you know what? There's a lot of things to complain about in the US. There's a lot of things that I don't agree with that we're doing around the world. And there's a lot of things that I'm embarrassed about for the US that have been in the past. But if I compare it to everywhere else, I'm happy to be here and I'm happy to support what America stands for, which is freedom and a fair playing field with a ladder where the rungs are spaced out far enough where people can climb that ladder if they want to. I think we were in a time a little while ago where those rungs are starting to space out and it wasn't a clear path for people to climb. I think that the rungs, a century ago were really, anybody could climb it. I think it's become more challenging, but I think that ladder in the US is better than any other ladder around the world. I could compare smaller countries, meaning there's like micro states that are very interesting, low taxes and they work, Singapore, Luxembourg, all those types of things. But when you look at a market where you have over 300 million people and a booming economy and resources and all these different things, there's nothing that compares to the US. So
I guess you guys have got built-in optionality as well, haven't you? Because you've got the 50 states to kind of move between.
Absolutely. And that's one of the things that I think outsiders don't realize about the United States is, again, what makes it on the news is like riots in Los Angeles or, feces all over San Francisco or the rats in New York. And that exists. For sure that exists. I'm not going to pretend like there's no issues there. But you know what? There's hundreds of thousands of square miles of nothingness where you could buy a ranch, or you could go backpacking or dirt biking or ride a horse, or you can go move to Alaska, or you can go to Hawaii, or you can go to Florida, you can go to the swamp, you can do whatever you want and no one's going to mess with you. You can put a gun on your hip. You can do whatever you want. You can choose. It's like choose your own adventure. And I think there's very few countries where you can do that. You could go live in the middle of Alaska in a cabin and grow a long beard and be a crazy, survivalist. Or you can go to New York and try and keep up with the Joneses and hustle and make a lot of money and run a hedge fund. And in that spectrum, you can do whatever you want. And I think that's one of the beauties of the United States that a lot of people forget about. And you know what? That's why there's a line of people trying to get in here, whether they're coming in illegally or legally. That's why people want to come here. And that's what I've learned after investing around the world and getting exposed to all different types of cultures and economies and opportunities. There's a lot of great opportunities. But when it comes to a home base, for me, the United States makes the most sense.
Cool.
I said what I said. I'll die on this hill.
I just want to, before we wrap up, I just want to get your insights in terms of if you were starting out again, what would you do differently, if anything, given today's situation?
Everyone hears this type of question on a podcast interview, and always people are like, oh, I wouldn't have changed anything. I would have done exactly what I said. And I feel like on one hand, I'm tempted to say that, but of course I would have done things differently. I mean, I made so many mistakes. And what I know now, I would have done 1,000 things differently. I would have just bought Bitcoin in 2009. Like that's what I would have done. But to answer your question more succinctly, I think I would have done what I did, but I would have taken far more risk. Far more risk. Risk.
Yeah.
And the reason why is because I think risk usually with a person, with what they're doing in their life, is overrated. I'm talking about like putting yourself out there, speaking up to voice your opinion on something, getting on an airplane and traveling somewhere, knocking on the door and trying to talk to somebody, emailing somebody, picking up the phone and calling somebody that you want advice for. I think that type of risk is what I wish I had done a lot more of. And actually, I should be listening to myself today because I should be still taking more risks. I think the risk that people take with their daily activities is far overrated. People think they're taking too much risk, but it's the complete opposite. So I would say that the risk with money is a different story, but I would say that money typically follows the risks that you're taking with your personal life.
Cody, thanks so much for coming on the show today. I really appreciate it. And hopefully we can get you back sometime soon and we'll delve into some of these topics in a bit more detail. But until then, thanks very much.
I appreciate you spending time and letting me stand on the soapbox. I will step off now, and I appreciate your time. See ya.
Cool. Take care. Thanks again to Cody for his time today. You can follow Cody's work at explorerequity.com and codyshirk.com. Both links are in the show notes. Don't forget to subscribe if you enjoyed the pod, and thanks for listening, everyone.